Welcome back, everybody. Today we're analyzing United Health Group. Currently trading at $492 a share. I have them pulled up here on TradingView, and we're going to do our best to take a look at the numbers here. They've got a 5-year chart. They're up 92% in the past 5 years, which did outpace the S&P 500, pretty sure. Um, they are a $450 billion company, which is pretty large. Biggest healthcare company in the world, probably. Their price to earnings ratio of 20, so not too steep. They have a dividend yield, not that big of a deal. They also have this Optum brand, which is kind of like a technology brand. So they're kind of like a technology healthcare type of company. Let's take a look at their financials and their annual revenue growth. Here is their annual revenue growth right here. And it looks like the last 3 years they've grown at a steady clip of 10%. Even last year they were up 14% in revenue, which is actually really, really, really good, especially with like the slowing economy. But we're getting more and more old people, so lots of people that are going to need this healthcare. So that's probably why their revenue is up so much. And their earnings pretty much follow their revenue because they've kept 6% margins like the whole time. Their balance sheet, they've got net debt of 42 billion, and actually it is a pretty good balance sheet. 42 billion in debt. They made 22 billion in earnings. It's not bad at all. Cash flow. Cash flow follows their earnings really close. 25 billion in cash flow. What are they doing with the cash? Looks like they bought back like 6.65 billion in debt or in stock. They bought back stock, and then they paid 6.7 billion in dividends as well. All right, so it looks like they are returning cash to shareholders, which is good to see. Let's check their stats and see what their profit margins are looking like. Their ROIC right here at about 15%, which is really awesome to see. It's 15% every single year. And then their, what the heck, net margin right here has been hovering around 6% the entire time as well. So makes it pretty easy company to analyze. We can actually just go to Yahoo Finance and check the estimates for this company. The average estimate for next year is 27.77 earnings per share, or dollars per share, basically. And then the next year after that up to 31, or like a 10% jump. And then the revenue going from 401 billion to 432 billion, which is like a 7.7% increase. But remember the last year they were up actually 14%. So that might be low actually, but we'll see. 7%, I think that's reasonable. Let's check out I plugged all the numbers into my DCF model, and let's check it out here. Let's check it out here. Here it is. I put the EPS estimate, the revenue estimate here, buybacks and net debt, and then the discount rate of 10% because I want a 10% return on all my stocks. Exit multiple of 20. Currently, they are trading at 20, and I think an exit multiple of 20 is fair for this business because it is a high quality business with a good moat, being one of the biggest healthcare companies in the world with their technology brand of Optum. I think that they can command an exit multiple of 20, probably even higher would be okay. Um, for their earnings growth, I did 9%, 8, 7, slowing down to 6%. And then revenue growth here, 8775, like really, really simple revenue growth. It's possible that they have higher revenue growth than this, especially with all the old people. But I definitely think that they're going to have positive revenue growth every single year. I really don't think that it's going to go negative ever. And then their profit margin of 6%, it's been super consistent. So I just did 6% all the way across. And using this, I think, rather conservative estimate, we get a fair value of $503 a share after they pay off all the debts. In reality, their fair share price is somewhere in between 503 and 548. So maybe like 520 would be a fair share price. And with them currently trading at $493 a share, this is a stock that I actually do own in my own portfolio. So I do think it's a buy here. Um, you'd be expecting about a 10% return moving forward with the stock, which is better than treasuries at the moment. So, um, yeah, definitely not bad. You're not going to get like eye-popping performance from this one, but still 10% is not bad, and I'll take that all day long. So, yeah, that's my analysis of United Health Group. Hope you guys enjoyed. If you did, make sure to hit that like button. Otherwise, leave a comment in the comment section if you have any questions. I also leave this model in the description for y'all to use. It's completely free. You guys can use this model. I just built it using all the free stuff on Google Sheets. So give this model a try, and yeah, I'll see you in the next one.